You know, typically when we look at the global financial dashboard during like a major geopolitical event, it sets off all the alarms.
Oh, absolutely. Red flashing lights everywhere.
Right. You expect massive spikes in volatility, everyone essentially panicking on the trading floor.
Yeah.
But right now you look at the screens and the financial markets are eerily calm.
It's almost weirdly quiet.
Yeah. Spread widths on sovereign bonds haven't really widened much. Currencies seem to be, consolidating. On the surface, it looks like just another Tuesday for your portfolio.
Right, but that glassy ocean is a complete illusion. I mean, if you look at asset prices today, they are telling a story of perfect containment.
They're assuming this is just a temporary hiccup.
Exactly, a temporary hiccup in the global supply chain.
And that illusion is exactly what we're tearing down today. Welcome to the Deep Dive. Today we are unpacking a really sobering dispatch from our source, the Sovereign Dispatcher.
Yeah, and they focus heavily on global sovereign credit risk.
They do. And our mission for this deep dive is to explain a pretty profound argument they make, that the recent 3-week closure of the Strait of Hormuz is not just some temporary supply shock.
Far from it.
Right. It's a permanent rewiring of global finance. We are essentially entering an era where geography is becoming the new credit rating.
Which is a fundamental shift, for anyone managing a portfolio or even just trying to understand the global economy right now.
Definitely.
Because the markets are treating the Hormuz closure as they call it a recoverable supply disruption.
The prevailing logic is basically the strait is closed, energy prices bump up for a bit, but eventually diplomatic pressure mounts, right?
Right.
The boats sail again, and the mass returns to normal.
Yeah, the market is basically trusting the asset prices to tell the truth. But the sources are flashing a massive warning sign here. They're saying, do not trust those prices.
Because the real story is hidden in what governments are doing, right? Like their quiet policy actions.
Exactly. Those quiet actions reveal that for energy importing frontier countries, so nations that fundamentally rely on buying their fuel from abroad, the floor is completely giving way.
The dispatch describes them as falling down an import ladder.
Yeah, the import ladder. And to understand why that's happening, we have to look at how international finance actually works under the hood.
Okay, let's get into the mechanics.
Think about the International Monetary Fund, right? The IMF. They build these massive, complex financial models for developing nations. They're called Article IV baselines.
Okay, let's pause there for you listening, because Article IV baseline sounds incredibly dense.
It does, yeah.
Mechanically, what is that baseline actually doing for a country? Like, why does it matter?
It's essentially a multi-year economic blueprint. I mean, it dictates everything. It projects how much a country will export, how much it will import, what its inflation rate will be.
Right.
And based on all of that, it tells them how much debt they can sustainably carry. And those massive billion-dollar models were built on one foundational assumption.
Which is that global shipping lanes would operate normally.
Specifically, the Strait of Hormuz. They assumed energy prices would just stay within a predictable band.
So because the strait has been closed for 3 weeks, that whole assumption is shattered.
Completely shattered. I mean, the energy shock has permanently altered the cost of importing fuel. That entire IMF baseline is now mathematically obsolete.
The formula just doesn't equal reality anymore.
No, it doesn't.
And we're seeing that reality play out in how governments are responding.
Yeah.
I want to highlight the distinction the dispatch makes between a government subsidizing energy and a government rationing it.
This is such a crucial difference.
Yes, because subsidizing is painful, sure, but I like to think of it like an unexpected household expense for the listener. Say you get an unusually high heating bill in the winter.
Right.
Subsidizing is like dipping into your savings account to pay that bill. You're saying, I can cushion this blow. I have the reserves.
You're financially stretching, but the house stays warm?
Exactly. But rationing is fundamentally different. Rationing is like turning off the heat completely in half the house. You're saying, I simply cannot afford this.
What's fascinating here is that when governments transition from subsidizing fuel to rationing fuel, which is exactly what we're seeing right now from Bangladesh to Zambia, they aren't saying, we will cushion the blow anymore.
They're physically surrendering.
Yes. They're telling their citizens, we simply do not have the physical U.S. dollars required to buy the energy this country needs to function. So they're turning the lights off.
Which is terrifying. And in the world of sovereign debt, rationing is the earliest administrative stage of a sovereign credit event.
It's the first domino of a default. I mean, the bond market might not have noticed the mathematical failure yet, but the government is already admitting it by shutting down power grids.
Okay, let's unpack this and ground it in specific geography, because the impact here is brutally selective, isn't it?
Very. It depends entirely on where you sit on the map.
So let's start with the double whammy hitting Asia right now, specifically looking at the Philippines. Our sources say they are currently caught in a textbook stagflation trap.
Yeah, the governor of the Philippine Central Bank, the BSP, recently came out and stated publicly that they're caught between a rock and a hard place.
Because they have two mandates that are suddenly at war with each other.
Exactly. They need to keep inflation from spiraling out of control, which usually means raising interest rates. But they also have a growth mandate to keep their economy expanding.
Which requires lowering interest rates.
Right. And when energy prices are permanently ratcheted up because of a choke point closure, you simply cannot achieve both.
The IMF had modeled a really clean, predictable monetary easing cycle for Manila.
Yeah, they did. The assumption was inflation would cool down, the central bank would lower rates, and the economy would just cruise.
But that baseline is dead.
Yeah,
The central bank is paralyzed.
totally paralyzed.
So if their playbook is broken, what does that actually mean for you, the listener, if you have exposure to emerging market debt? Like if I'm holding a 10-year Philippine government bond right now, am I basically trapped?
The duration risk is incredibly high right now. Just to explain the mechanics of that. When you buy a long-term bond, you're locking your money up for years in exchange for a specific yield, or the carry.
You're betting the yield outpaces inflation.
Exactly. But in a stagflation environment where inflation stays permanently elevated due to those imported energy costs, that yield gets eaten alive.
Wow.
The compensation you receive just doesn't cover the risk of holding that asset for a decade. So the actionable takeaway from the dispatch here is to be highly cautious on Philippine duration and local currency bonds.
You'd want to pivot toward shorter-dated U.S. dollar instruments to protect yourself.
Yep, shorter duration is key.
Wait, I have to ask about a massive piece of the Philippine economy that seems like it should offer some protection. Isn't the Philippines incredibly dependent on remittances from overseas workers?
They absolutely are.
Right, they have millions of workers sending billions of U.S. dollars back home every year. Shouldn't that huge influx of hard currency act as a shock absorber against high energy prices?
Well, that is the exact safety net the traditional IMF models rely on. And it perfectly illustrates why those models are currently failing.
Oh, really? Why?
Because you can't just look at the fact that remittances exist. You have to look at the geography of where those remittances come from.
Oh, I see where this is going.
Yeah. A massive portion of those overseas Filipino workers are stationed in the Middle East, specifically in the Gulf.
Ah, so the geography tax hits the lifeboat too.
Exactly. You're seeing the connection. The very conflict that closed the Strait of Hormuz is simultaneously disrupting Gulf labor markets.
So they're getting hit from both sides.
Yes, we are seeing hiring freezes in the UAE, mega projects being delayed in Saudi Arabia as capital is preserved. So the Philippines is getting hit with a second-order shock.
The cost to import energy skyrockets, and the primary source of dollar income they use to buy that energy is drying up at the exact same time.
It's a cascading failure.
And if we look a little further west to Bangladesh, we see another brutal feedback loop. You mentioned rationing earlier as a diagnostic signal. The power rationing in Bangladesh right now carries a massive diagnostic weight, doesn't it?
Oh, absolutely. For their credit health, it's a glaring red light. The IMF's stabilization plan for Bangladesh relied almost entirely on their garment export revenues.
Because they're a massive global hub for textile manufacturing.
Right. The mathematical model assumed Bangladesh would sell millions of garments, bring in vast amounts of foreign currency, and use that hard currency to balance their current account and service their debt.
But let's look at the physical reality of the factory floor. Garment manufacturing is highly energy intensive.
Very.
You have thousands of industrial sewing machines, massive ventilation systems, dyeing vats. All of that requires constant power. If the government implements rolling blackouts to ration energy because fuel is too expensive,
The factories physically cannot run, the production lines just stop, and if they produce fewer garments, their export volume collapses.
which means the U.S. dollar revenue they desperately need to buy the now expensive imported energy just vanishes.
It's a dual hit that the IMF simply never modeled for. I mean, they modeled a scenario where fuel costs more, but exports remain stable?
They didn't model the physical reality that expensive fuel stops the exports from existing in the first place.
Exactly. The math spirals downward. Their import bill goes up, their export revenue plummets, and the central bank's reserves bleed out far faster than the spreadsheet predicted.
So for portfolio positioning, the dispatch is pretty clear. Be exceptionally cautious on any long-duration instruments in Bangladesh.
Highly cautious. The structural integrity of their debt repayment model is deteriorating rapidly.
So if Asia is trapped because they import energy to build things,
Yeah,
what happens to countries that just export raw materials?
that's a great question.
You'd think a massive commodity exporter like Zambia in sub-Saharan Africa would be somewhat immune to an energy shock, maybe even benefit from high commodity prices. But the dispatch outlines a really chilling, silent crisis happening there too.
Yeah, Zambia is fascinating because it was supposed to be the poster child for recovery. They recently completed a landmark, massive debt restructuring backed by the IMF.
In the sovereign debt world, this was heavily celebrated. It was supposed to signal a durable fiscal recovery, right?
It was, but the dispatch points out a fatal flaw in the plumbing of that restructuring deal.
Let's look at how a restructuring actually works.
So the IMF uses something called a debt sustainability analysis, or DSA. It is basically a strict mathematical bridge.
Right.
The IMF and creditors agree to forgive a certain amount of debt, but only if the country agrees to hit very specific, austere budget surplus targets over the next 5 to 10 years.
So you have to be able to predict your costs with incredible accuracy to promise those surpluses.
And that is the fatal flaw. The Zambian DSA was calibrated on a baseline that entirely excluded the possibility of a major sustained energy price shock.
They built this intricate financial bridge, assuming there would never be a geopolitical hurricane.
But the hurricane is here. Because of the Hormuz closure, Zambia is now actively rationing fuel.
Here's where it gets really interesting, though. To keep the country functioning, Zambia is being forced to divert its incredibly scarce foreign exchange reserves away from the central bank.
Yeah, they're taking those reserves and dumping them into buying emergency diesel at inflated spot market prices.
Even though the IMF program explicitly demanded they rebuild those reserves to protect against future defaults.
Exactly. Instead, they are burning them just to keep the lights on.
The disconnect here is staggering. If you pull up the financial news today, the official headlines probably say something along the lines of Zambian IMF program on track.
Sure, on the surface.
But under the hood, they are violating the debt sustainability analysis in slow motion.
Violating the baseline in slow motion captures it perfectly. It is the sovereign debt equivalent of structural dry rot.
From the outside, the house looks freshly painted.
Right. The bond market hasn't priced in a collapse because there hasn't been a missed payment yet. But the foundation, the math required to make those future payments, is disintegrating.
So the actionable takeaway from our sources is to aggressively prefer shorter duration across Zambia's restructured debt. You want to be holding the paper that gets paid out before the market wakes up to the math.
Absolutely. Okay, so we've walked through countries suffocating under this new geography tax. The Philippines, Bangladesh, Zambia.
They are all trapped by their physical need to import energy through vulnerable choke points.
But in global finance, capital doesn't just disappear. It flows somewhere else.
So what does this all mean for the heavyweights? If the frontier markets are losing, who is actually winning this new geographic reality right now?
This brings us to perhaps the most structurally significant and surprising market development of the year. Amidst this massive geopolitical crisis and energy shock, Chinese government bond yields are actually going down.
Wait, I need to make sure I'm hearing that right. In the middle of a global crisis triggered by a conflict in the Middle East, capital is flowing into Chinese debt.
It is.
Usually when the world gets scary, every investor on the planet blindly rushes into U.S. Treasuries. It's the ultimate undisputed safe haven.
Are you saying capital is actively choosing Beijing over Washington right now?
I am. For the first time since the 2008 financial crisis, Chinese government bonds, or CGBs, are functioning as a credible war haven asset.
Oh, wow.
Investors are buying them specifically for safety. And the mechanics of why this is happening are entirely tied to the thesis of the dispatch. It all comes back to geography.
Let's unpack the mechanics of that. Why does China's geography make their debt safer during a Middle East energy shock?
Because China has methodically built a domestically anchored energy position that totally bypasses maritime choke points.
Like Hormuz.
Exactly.
Oh.
They have immense domestic coal reserves, they lead the world in rolling out domestic renewables, and crucially, they have secured vast access to heavily discounted, sanctioned Russian crude oil.
And that Russian oil flows overland via pipelines, right? Or through shadowy maritime routes that don't rely on the Strait of Hormuz. Exactly. They have essentially insulated their central bank's balance sheet from the Middle East. If Hormuz closes, Europe panics, Asia panics, but China's factories keep running on Russian oil and domestic coal.
Their fiscal framework doesn't shatter.
Right. No other major emerging market sovereign can replicate that geographic insulation right now. And the implications of this are massive for the global financial order.
Because it directly threatens the U.S. dollar's reserve currency premium.
Precisely. Historically, the U.S. could borrow money cheaply because the world viewed the dollar as the only safe place to hide during a crisis.
But if global investors realize they can park their capital in Chinese debt during a Middle East war and actually be insulated from the energy shock, the dollar's monopoly on safety begins to crack.
It does. The dispatch suggests a very constructive view on CGBs going forward because of this.
That fundamentally alters how we have to think about global capital flows. And what about India? The sources mention an asymmetric view on Indian hard currency. What are they doing differently than, say, the Philippines?
India provides a masterclass in institutional sophistication. Instead of passively watching their currency get hammered by the energy shock, the Reserve Bank of India, the RBI, is aggressively and proactively intervening.
Intervening in what's called the non-deliverable forward market, right? The NDF market.
Yes, the NDF market.
For the listener who doesn't trade complex derivatives, how does an NDF market intervention actually protect the Indian rupee?
Normally, if a central bank wants to stop its currency from losing value, it has to sell physical U.S. dollars from its onshore reserves to buy up its own currency.
It physically drains the vault.
Exactly. But the NDF market allows a central bank to trade currency futures offshore. They can enter into derivative contracts that settle in dollars at a future date.
So they are essentially fighting off currency speculators and absorbing the market's panic offshore without having to empty their physical onshore dollar reserves today.
That's exactly it.
To use an analogy, it's kind of like a major airline that knows fuel prices are going to be volatile. Instead of just buying jet fuel at the spot price every single day and letting a crisis bankrupt them, they use sophisticated hedging contracts to lock in the price of fuel for the next year.
Right.
They absorb the shock mathematically before it hits their physical cash flow.
That's a great way to look at it. The IMF's models assume a passive response to an energy shock, that the currency just depreciates mechanically. But the RBI is actively beating the IMF's assumptions through sheer technical competence and financial engineering.
It totally differentiates Indian sovereign credit from the rest of the pack.
It really does.
It's fascinating how different countries are wielding the tools they have. But if we accept the premise that geography is the new credit rating, we have to look at the map for the next fault line.
Because Hormuz isn't the only vital waterway on the planet.
Exactly. Which brings us to the final and, frankly, most chilling section of the dispatch. The next Hormuz, Taiwan.
Recently, Taiwan announced a massive $2 billion sudden reinforcement to their Coast Guard.
And they explicitly stated this expenditure was in direct response to the closure of the Strait of Hormuz.
They did. Now, most people reading that headline in the morning paper would just view it as a standard defense story.
Right. Geopolitical tensions are high, so military budgets go up.
But if we connect this to the bigger picture, if you view it merely as a defense story, you are missing the underlying financial reality. It is a blaring sovereign credit signal.
Because Beijing has been watching the Hormuz closure with intense scrutiny.
Oh, they are studying the exact economic playbook. They are watching how long it takes for a distant strait closure to force rolling blackouts in Bangladesh and drain foreign exchange reserves in Zambia.
Because if you can close a maritime choke point and instantly place a crippling tax on the entire global economy, forcing industrial halts and inflation spikes without ever firing a missile in a conventional war, you have created an unbelievably powerful weapon.
It ceases to be just an act of war. It becomes an incredibly efficient geopolitical instrument of statecraft.
And Taiwan recognizes this.
Yes. They realize the probability of the Taiwan Strait becoming the next strategic choke point is rising in real time.
And the really terrifying part for anyone managing money is that this tail risk is completely invisible in the bond market right now.
It is entirely unpriced. Asian sovereign credit markets absorbed the Hormuz closure as an isolated, unfortunate event in the Middle East.
They have not even begun to price in the mathematical possibility that shutting down global waterways is just the new normal of how superpowers exert leverage.
Not at all.
Synthesizing everything we've unpacked today, the title of the final section of the dispatch really drives the entire thesis home. They call it the weight of still water.
The stillness in the market right now is the trap.
The most dangerous moments in financial history rarely look like a movie scene. There are no dramatic alarms or screaming traders. They happen quietly.
Very quiet.
They happen when central bank governors use polite euphemisms about impossible choices. They happen when sophisticated investors look at a frontier country that hasn't officially missed a bond payment yet, and they confuse that absence of a headline default with actual structural stability.
If there's one thing you take away from this analysis, let it be this. Those power rationing notices in Dhaka and those emergency diesel purchases in Lusaka are not minor, localized policy adjustments.
They're legal confessions.
Yes, they are governments declaring out loud that the mathematical models keeping their economies afloat have been completely superseded by physical reality.
The glassy, still water you see in the global markets today is not a reason to be complacent. It is the last affordable moment to reevaluate your exposure.
Because once the market wakes up and finally prices in this new geographic reality, the cost of adjusting will be exorbitant.
The map has quite literally become the trade. Which leaves you with one final lingering question to mull over long after this deep dive ends. If strait closures are transitioning from rare catastrophic emergencies into standard everyday tools of geopolitical leverage, how long until global supply chains simply stop treating oceans as open highways and start treating them as hostile borders?
It changes the entire equation.
It really does. Thank you for joining us on this deep dive into the sovereign debt landscape. We'll see you next time.